Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Amprius Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clear buy and sell signals, you can check out VIP indicators through my link below. The campaign is row $100 to $10 K use day with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So I want you to imagine a company, right, that just secured this staggering $500 million in orders from the United States military.
Yeah, which is just a massive amount of incoming business.
Exactly. And it pushed their revenue up like 2.5 times in a single year.
Right.
But then take that exact same company and imagine its stock just plunging, losing massive value amidst these aggressive allegations of accounting tricks and shady suppliers.
Yeah, it's a wild ride.
It really is. I mean, we are looking at a financial landscape today that is the absolute definition of a high-stakes battleground. Amprius Technologies is standing right at the intersection of bleeding-edge innovation, geopolitical tension, and cutthroat Wall Street drama.
All right, let's move into the wealth building context because, before we can dissect the stock price chaos, we really have to understand why the U.S. military is suddenly handing out $500 million contracts to a battery manufacturer.
Right, because there's a huge macro trend here.
Exactly. We are currently watching the U.S. government actively try to decouple its entire military supply chain from overseas manufacturing, especially from China.
And that geopolitical shift is just massive. Like, if you are building a long-term portfolio, you look for companies that are positioned in front of these unavoidable trends. You've got the National Defense Authorization Act, or the NDAA, which basically mandates that the military cannot use critical components like drone batteries if they're made by foreign adversaries.
Right, and that's where Amprius comes in. They provide this technological leap that fits perfectly into that decoupling because their batteries are fully NDAA compliant. It acts as this enormous regulatory shield.
Which creates immense switching costs, right?
Yeah, absolutely. I mean, the Department of Defense isn't just looking for a secure supply chain. They're looking for a real tactical edge. So for decades, the industry standard for lithium-ion batteries has been to use graphite for the anode.
Okay.
And graphite is stable, but its capacity to store energy is actually pretty low. Silicon, on the other hand, has an incredible theoretical capacity to hold lithium ions.
There's a catch with silicon, isn't there?
Yeah, there's always a catch. The historical engineering problem was that silicon expands and cracks when you charge it, which just destroys the battery. But Amprius engineered this proprietary silicon anode structure that actually solves that degradation issue.
And the practical application of that breakthrough is what completely changes the game for aerospace. I mean, they are producing cells that deliver up to twice the energy density, twice the range, and twice the flight time compared to conventional graphite batteries.
Which is wild when you think about it.
It is. Imagine magically replacing a surveillance drone's standard fuel tank with one that holds twice the energy, giving it double the flight time without adding a single ounce of weight to the aircraft.
Oh, wow, yeah.
So in military aerospace, where weight and endurance are literal life-or-death metrics, how much of a premium is the military willing to pay for that literal weight-to-power advantage?
A huge premium. If a drone can stay in the air for 4 hours instead of 2, it reduces the number of times soldiers have to retrieve and swap batteries, right? So it minimizes their exposure to danger on the battlefield.
Yeah, that makes total sense.
And once a defense contractor designs an aircraft around a battery with those specific specs, they can't just swap back to a heavier, less efficient graphite alternative without completely redesigning the drone from scratch. It's a massive competitive moat.
Now let's look at the fundamentals. Because having the best technology on paper doesn't really matter if you bankrupt the company trying to mass produce it.
Right. That is always the risk with hardware.
Exactly. Building battery factories, they usually call them gigafactories, traditionally requires raising billions of dollars, taking on massive debt, and spending, upwards of 5 years just on permitting and construction.
Oh, yeah, it's incredibly capital intensive.
But here's the crazy part. Amprius is projecting capital expenditures of under $10 million for the entirety of 2026.
Wait, really? Under 10 million?
Under 10 million. And I mean, if you're analyzing your own portfolio, you know that physical manufacturing burns immense amounts of cash. So a company projecting to fulfill a $500 million backlog with less than 10 million in capex seems like a glaring paradox. How do they physically produce the batteries without building the factories?
Well, so they utilize what they call a manufacturing light business model.
Okay, what does that mean?
Instead of building massive proprietary gigafactories from scratch, they rely heavily on contract manufacturers. They partner with established companies, like Nanotech Energy, to produce the actual physical cells.
Ah, I see.
Yeah, and this strategy allows them to scale their capacity rapidly to meet that huge backlog without the multi-year delays and capital risks of traditional heavy manufacturing. It keeps their balance sheet incredibly lean.
But when a company outsources the core of its competitive advantage, like the actual manufacturing of the batteries, don't they risk losing control of their intellectual property or running into quality control failures?
Yeah, you hit the nail on the head.
Yeah.
That is the central tension of the manufacturing light model.
Right.
But their strategy is actively being validated by the government. They actually just secured a $3.3 million contract from the Defense Innovation Unit, or DIU.
That's a solid vote of confidence.
It is.
Yeah.
It serves as a key liquidity booster, and it really demonstrates that the Department of Defense is comfortable enough with this outsourced manufacturing framework to fund their operational scaling directly.
Nice.
And financially, it is bearing fruit. In the first quarter of 2026, their revenue surged 2.5 times year over year to $28.5 million. And they've also raised their full year 2026 revenue guidance to at least $130 million.
And it's not exclusively defense contracts either, right?
No, actually, they secured a $21 million purchase order for their cylindrical cells from a premier Chinese light electric vehicle customer. So you're seeing commercial validation happening right in parallel.
That's huge. And the gross margins expanded to 20% in the first quarter, which is a major swing from a loss in the prior year. Plus, management is targeting positive margins of 25 to 27% by 2028.
Which is very healthy. And that brings us to the catalyst timeline. The market is intensely focused on the upcoming Q2 earnings report on August 6, 2026.
Yeah, that's going to be a big one.
Because of all the recent volatility and the allegations we're going to get into, the fundamental question for this earnings call is execution. Investors need to see proof that the company is actively converting that $500 million backlog into recognized revenue without supply chain disruptions.
Now let's pivot to the chart. Because for a while, the market really loved this lean manufacturing narrative. I mean, the stock ran up nearly 490% over the last year, hitting a $2.35 billion valuation.
It was a massive run.
But then the stock experienced a brutal technical washout. And for anyone unfamiliar with the mechanics of a washout, it happens when a stock falls so fast and so hard that it breaks through all major technical support levels.
Right, it just drops like a rock.
Exactly. It triggers automated sell orders and margin calls, and it violently flushes out the weak hands until only the high-conviction, long-term buyers are left standing.
And a major factor complicating that chart is the recent warrant exchange. This is a really vital piece of financial engineering to understand.
Okay, break that down for us.
So a public warrant is essentially a contract that gives an investor the right to buy a new share of stock at a specific price, in this case $11.50 at a later date. And Amprius had 7.1 million of these public warrants outstanding.
Let's unpack the mechanics of that for a second, because 7.1 million warrants creates a massive technical supply overhang.
Oh, absolutely.
Because if the stock price crosses $11.50, those warrant holders will exercise their right. And then the company is forced to issue 7.1 million brand new shares into existence, which instantly dilutes the equity pool.
Right. The company's underlying value hasn't changed, but suddenly the pie is sliced into millions of extra pieces, making every existing share worth less.
Exactly. And market makers know this overhang exists, so it acts like this invisible ceiling on the stock price. It just keeps it pushed down.
Yeah, and to dismantle that ceiling, Amprius proactively negotiated an exchange. They actually swapped those 7.1 million public warrants for just 2.7 million common shares.
Okay, so wait, is this a desperate act by a struggling company, or is it a genius piece of financial cleanup?
It's definitely a proactive defense mechanism. By offering this deal, they issued 62% fewer shares than a physical exercise would have demanded. So they completely eliminated a massive chunk of future dilution.
Oh, that makes sense.
And they achieved this balance sheet cleanup without draining any of their actual cash reserves to buy the warrants back.
So what does market sentiment look like then? Because we are seeing a severe tug of war right now. On one side, corporate insiders sold $79 million in stock between late 2025 and mid-2026.
Which never looks good.
Yeah. No, on the surface, executives dumping shares usually triggers retail panic. But on the other side of the trade, the institutional holders, the sophisticated funds managing billions, they willingly participated in that warrant exchange. They explicitly chose to take equity.
Right. The fact that institutional capital agreed to trade their warrants for common stock signals, they are confident enough to hold that equity long-term, looking past all the short-term noise. And currently, the stock is trading around 24% below the analyst consensus target of $21.25.
Now let's talk about the risks, because you don't lose massive market capitalization without a serious catalyst. And in this case, the catalyst was a scathing short seller report from a group called Manatee Research.
Yeah, that report was brutal.
It really was. They systematically attacked both the supply chain and the accounting practices. On the manufacturing side, they claimed Amprius relies on highly questionable contract manufacturers. They specifically highlighted a factory tied to Eurocell that was allegedly seized, and they called another supplier named Libest subscale.
And it didn't stop there.
No. They also highlighted massive concentration risk in the cost structure. They point out that 36% of their cost of revenue goes directly to a former affiliated company named Berzelius, while simultaneously noting that just 2 customers make up 64% of their accounts receivable.
Wow.
Yeah, putting all your eggs in one basket for both your supply chain and your revenue is inherently dangerous.
Those concentration risks are entirely legitimate. I mean, if a company relies on 2 buyers, losing one is catastrophic.
Exactly.
However, it is crucial to note that both the customer concentration and the relationship with Berzelius are explicitly disclosed in their SEC filings. So this wasn't like a hidden offshore network the short sellers just uncovered. It was transparent, audited information.
Right, it was already public knowledge.
Exactly. And as Amprius scales up their U.S. manufacturing partnerships, like the one with Nanotech Energy, that concentration risk should naturally dilute over time anyway.
But the accounting allegations are arguably the most severe part of the bear case here. Manatee Research accused the company of exaggerating their orders through aggressive bill and hold accounting, pointing out that their days sales outstanding, or DSO, has been climbing sharply.
Yeah, let's pause on bill and hold, because for anyone analyzing an earnings report, that phrase usually sets off alarm bells.
Big time. It basically implies a company is recognizing revenue on their financial statements before the product has actually been shipped to the buyer. If I see a company reporting aggressive accounting alongside exaggerated orders, that sounds like a textbook red flag to me.
I get that. Under generally accepted accounting principles, or GAAP, bill and hold is heavily restricted. But it is legal under very specific circumstances.
Okay, like what?
Well, you can't simply box up inventory in your warehouse and claim it as a completed sale just to inflate your top-line numbers. The customer has to explicitly request a shipping delay, often due to a lack of immediate storage space. And the product must be completely finished, separated from general inventory, and ready to move.
Okay, so it has to meet strict criteria.
Exactly. But Manatee Research framed this specialized accounting rule in the most pessimistic light possible, implying the entire $500 million backlog could just be vaporware.
And what about the climbing days sales outstanding? Because that metric tracks exactly how long it takes a company to actually collect cash from a customer after issuing the invoice. If DSO is climbing sharply, it means cash is trapped and customers just aren't paying their bills on time.
In a standard commercial vacuum, yes, a soaring DSO points to customers defaulting or a company extending reckless credit to artificially boost sales. But we have to overlay the specific profile of their primary customer here.
The military.
Exactly. The bulk of that $500 million backlog belongs to branches of the United States military. And if you've ever analyzed defense procurement, you know the Pentagon is notorious for having one of the slowest, most rigidly bureaucratic payment cycles on the planet.
That is very true.
The military demands incredibly rigorous vetting. They physically test the technology, they audit the supply chain compliance, and they verify every single line item before releasing government funds.
Right, so could this $500 million defense backlog actually be vaporware?
It is exceptionally difficult to fake a $500 million backlog with the Department of Defense. The slow payment cycle is just an inherent feature of dealing with the government, which perfectly explains the climbing days sales outstanding. The short report effectively weaponized the slow bureaucratic years of the military, framing a standard government delay as malicious corporate fraud to trigger a sell-off.
So with everything on the table, what's the final verdict?
The underlying analysis gives this stock a 7 out of 10 bullish score. Taking a long-term, multi-year investment view, the fundamental story remains intact. They are operating a manufacturing-light model, pushing past $130 million near-term revenue and driving towards sustained profitability by 2028. The ultimate test is just going to be sheer execution. Can they deliver the physical silicon anode batteries to the military without the outsourced supply chain breaking down?
This entire situation is just a real-time, high-stakes case study of how massive geopolitical macro trends collide with the messy, volatile reality of public markets and short selling. Which leaves us with a final thought as we look ahead to their upcoming earnings. If this proprietary silicon anode technology is truly as indispensable and revolutionary for military aerospace as that massive backlog suggests, will Amprius even remain a public company long-term?
That's a fascinating question.
Right. With the stock price temporarily battered by short sellers, it may only be a matter of time before a massive defense prime contractor, one of the giants building the actual military drones, swoops in and buys Amprius outright. Sometimes the most efficient way for a defense giant to cross a competitive moat is simply to acquire the patent vault.
And if you want extra help reading trading charts, you can check out VIP indicators to the link below. The campaign is Grow 100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please consider subscribing, liking, and commenting underneath. We'll see you in the next Smart Wealth with Joshua episode.